Hi everyone, it's Jack back with another video. Today I'm going to be talking about LVMH, business that doesn't get anywhere near enough coverage, mainly because it's a European stock. That is Louis Vuitton, MOAT, Hennessy, fashion conglomerate, owns all sorts of watch, champagne and luxury fashion brands. $400 billion market cap company, by far the biggest in its space, with only the real competitor being another European listed name in Kering. Currently trades at PE ratio on a trailing basis around 28. It's right near its 52-week highs, pretty much the highest it's ever been. Pays a nice dividend, although not particularly consistently. And while we could have picked it up cheaper in the year, it's brought out some fabulous results recently, so I want to analyse it, let you know what I think of it, and then you let me know in the comments below what you think of it. Like and subscribe if you enjoyed the video. Let's get right into it. For those who haven't heard of that LVMH, it's a conglomerate very diversified across fashion, champagne, wine and spirits, and retailers. So it owns Sephora, it owns Tiffany, Bulgari and Tag amongst others in the watch and jewellery space, and in fashion it owns many brands including Louis Vuitton, Christian Dior, Marc Jacobs and many more. Exceptional business, $10 billion of free cash flow this year, or just over 21.1 billion euros of profit from operations, and nearly 80 billion euros of revenue. All absolutely fantastic, growing at really strong rates. Truly international business. I'm going to get a bit deeper into the numbers, show you why this is such a fabulous business. In 2022, revenue was up 23%, 17% of that was organic growth, and 6% currency effect. I don't really care about currency effects, it's not a consistent metric. 17% organic growth is what we can rely on. That is fantastic growth for a company of this size and scale, to just over 79 billion euros from 64 billion euros. Really impressive growth at this scale, and doing that with a really well balanced growth across the geographic mix. Only 7% growth in Japan and 8% growth in France. France, of course, probably the most developed market for these sort of luxury goods. Many of these originating in France. 16% in Europe, excluding France. That's up versus 15% in 2021. Asia was up 30%. That's actually down 35%. Well, it's down from 35% in 2021. That's mainly due to the closing of shops in China, essentially. Other markets up 12% versus 11% in 2021, and United States 27% versus 26% in 2021. Overall, really impressive year. I think we can allow that the China story cannot be helped. Everywhere else, a growth year over year, or at least the same. Very impressive. You would imagine with cost of living crises all over the place and inflation rampant with a potential recession coming forward that luxury goods would suffer. This has absolutely not been the case, and has not been the case historically. It is no different this year. Ironically, champagne has been one of the strongest performers for this business, with revenue from champagne and wines up 24%. The MOAT brand in particular did particularly well, strong demand in Europe, Japan and emerging countries. There was increase in supply rates, but they have dynamic pricing power, and as they have incredible pricing power across all of the luxury brands, because they're already at ridiculous prices in some cases. What's another couple of percent? Revenue from cognac and spirits is up 14% versus 2021, particularly driven by the performance of Hennessy. They had a really strong partnership with NBA that has only increased the brand power of this business. The US was impacted by logistic constraints, and of course the health crisis in China has not helped this, but Hennessy has driven the spirits business particularly well, and Belvedere vodka has also done very well. For the business split by group, I'm going to ignore the reported number and go off the organic number, because that removes the currency effect, and currency effect is well out of LVMH's control. 11% increase in wines and spirits. The fashion and leather goods, which is by far the largest business, was up 20%. That's essentially, it grew the whole amount of wines and spirits in a year, which is absolutely tremendous. Perfume and cosmetics up 10%, watches and jewellery up 12%, and selective retailing, which is essentially the Sephora brand, the DFS brand in China and a couple of others, up 17%, for an overall organic growth rate of 17% across the whole business. Absolutely fabulous. One perhaps worrying trend for this business is that across the full year, half one was much stronger than half two, perhaps to some extent due to the China health crisis, but overall I think it's just due to a tightening in all markets and potential for recession. So across all business segments, every one of them had a weaker half two than half one. In addition to fabulous results this year and historically, this business also pays a dividend of around 12 euros, which it's an 800 euro stock, so that's not a very impressive dividend yield at all, about 1.5%. The annual average growth rate is 19% over the last 5 years. However, it's not been a particularly consistent business in terms of dividend growth. It did drop its dividend for 2019, even though the business wasn't really in that much financial distress at all. It's clearly not a priority for the business right now, and who knows what it'll be going forward. But in most years, they are growing it at a fabulous rate. You can see from 2020 to 2022, it has doubled. I think most people who look into this business will realise that it's a fabulous business, high quality business with long-term growth tailwinds that is very recession resistant. However, there is the question of valuation, and it is not a cheap company by any means. Current price to earnings ratio of around 29, which is below its 5-year average. However, this is not objectively cheap by any means. It's currently trading for around 23 times cash flow and 7 times book value. This is a company that has fabulous margins and generates a lot of cash flow. However, this is expensive for a company that's growing 17% organically, 20% overall, or 23% overall. But nevertheless, a 29p is expensive. Overall, I think it's obvious that this is a fantastic business. It perhaps trading a bit high on a PE ratio, but that obviously doesn't tell the full story. This is an extremely recession-resistant business, has fantastic margins because of the nature of the business. Intrinsically, luxury goods sell at far higher than cost, and some of the brands here are some of the most sought-after luxury brands in the world. LVMH is a really high-quality business that I think flies under the radar because it's European listed. It's a really high market cap business, but it's not often spoke about with other mega cap businesses, purely because it's European listed, in my opinion. That 1.5% dividend I don't think is really worth talking about that much because it doesn't seem to be a priority for the business. Going forward, who knows what they'll do. They seem to be returning cash to shareholders at a consistent rate over the long term, and the rate they're growing at, it seems like they care about increasing that dividend. For me, the valuation is actually okay. Objectively, a PE ratio of 29 is a little rich for a company that's growing at 20%, but at this size and scale, I think it's underestimated how impressive this is. And in a recessionary environment or a high inflation environment, regardless of whether this is a recession or an inflation resistant stock or not, I'd have been much happier to buy this company around the 500 to 600 euro mark. At 800 euros, I think it's perhaps a little richly valued, or at the very least, approximately fair valuation. For me, I'll be waiting for it to do a bit more because I tend to avoid buying stocks when they're at the peak like this. Who knows what will happen to it, but I'd like to see it drop a bit more, and perhaps if we go into a recession, then we'll see a little bit of a cheaper price, but it never tends to be objectively cheap, and even at a PE ratio of 29, that is below its 5-year average and below its long-term averages. So we'll see if a nice buying opportunity appears. Let me know what you think of this business. Of course, not a financial advisor, so you do your own research and due diligence, not just buy or sell stocks because I say so. Form your own opinions and let me know them in the comments below. Like and subscribe when you enjoy the video. I'll see you again next time.